Good morning from London. I'm Kriti Gupta alongside Tom McKenzie. We're an hour away from the opening trade. Here's what you need to know. Fed Chair Jay Powell signals an interest rate cut could come as soon as next month, despite division among policymakers over inflation and the jobs market. And Mario Draghi issues a dire warning, saying the EU can no longer rely on the size of its economy to bring influence onto the world stage. And the U.S. government takes an almost 10% stake in Intel worth $8.9 billion in an unorthodox deal funded by the CHIPS Act. Tom.
OK, let's check in on the markets then. US futures pointing a little flat right now after the gains that came through, of course. 1.5% upside for the S&P 500 by the end of the close on Friday. Stronger gains even for the Nasdaq 100, gains of around 1.9%. The Russell 2000 soaring close to 4% as well by the end of the close, all on the back of the pivot, of course, from Jay Powell. European futures, though, looking a little softer, down 0.3% after notching record gains last week. The Asian session, the strength is coming through from mainland China, even with all the question marks about potentially being in bubble territory. Across that regional gauge, you're seeing gains of around 1%. The baton being handed over to Asia, of course, on the back of expectations of that cut in September, about 85% priced in. The benchmark 2-year, not the benchmark, the 2-year, the benchmark 10-year is seeing yields up, but the 2-year at the front end, 371 after, of course, that rally that we saw on Friday. Pairing some of that just around the edges, yields up 1 basis point on the 2-year at 371. The countdown to the opening trade starts right now.
Good Monday morning. Lots going on the geopolitical front, lots going on the policy front, except no one here in the UK is here to see it. Don't worry, the European markets are open despite the bank holiday right here in the UK. But let's start with what we learned on Friday and over the weekend, which is, of course, the policy story out of Jackson Hole. The idea that a cut is on the table for as early as September. The first time, really, that Jay Powell is going as far as to kind of confirm that possibility.
And if we take a step back, early in the week, the drumbeat of commentary from Fed officials was caution, not committing to September.
Yeah.
Jay Powell comes out and he opens the door for that cut. He does not undermine the market pricing for September in terms of the first cut of this year for the Federal Reserve, even with inflation data where it is well above target and an unemployment rate that, yes, there's some questions around the edges as to the softness that we're starting to see, but an unemployment rate of around 4.2, 4.3%, and yet he opens the door for that cut. Is this a Fed official who's also looking, a Fed chair, who's also looking at what will be a reconstituted Fed around concerns that maybe he will be outvoted at some point, or is he more concerned in terms of the labour market data and getting ahead of that story?
The politics very much bleeding into the monetary policy there. I thought the line that was so interesting from his speech was that there is a possibility that this tariff kind of read-through is a one-time hit, which I think is code for transitory from his prior 2022 days. I think it's fascinating, though, that you do start to have Jay Powell talking about this, because this is, and Dan Curtis, our markets producer, pointed this out in one of his charts this morning, this is actually one of the longest periods that the Fed has been on pause in an easing cycle. And we don't really have a roadmap for what that looks like or how the market should even be pricing it. You mentioned in the 2-year market check this morning, you're looking at a 10-year of 426. So even with this kind of pricing that cuts are coming, you really haven't seen the Treasury market break out of its range.
And of course, we only needed to look back to 2024, to your point, to see an environment where the Fed is cutting and yet yields are grinding higher. So is that a story that starts to evolve and come back for this market as well as we look at Treasuries? On the labour market, that line, curious, a curious labour market, as Jay Powell pointed to both a drop-off in demand for workers and yet also a drop-off and a decline in supply. The crackdown on immigration having an effect in terms of muddying the water when it comes to clarity on the jobs market of the U.S. as well.
I thought it was fascinating as well that was the U.S. take, at least when it comes to monetary policy officials. We've got plenty of commentary from other global central bankers as well. Christine Lagarde, of course, was in attendance. Andrew Bailey, Governor Ueda, among many, many others. And the commentary from outside the U.S. seemed to be really centered around independence when it comes to monetary policy, really underscoring that of their own central bank decisions. That being said, let's go to another story that's catching our eye this morning. Mario Draghi making headlines over the weekend, really saying that the EU is not where it used to be and kind of undermining this idea that I think we started talking about in the States, which is that ultimately foreign policy and economics have now started to clash in the States. And that basically, as Donald Trump is passing on his trade agenda, he's using economics as a weapon, basically, to talk about, or as a tool, I should say, to talk about geopolitical outcomes. You can see that in the likes of Russia. You can see it in the likes of Israel and other parts of the world as well. Now, Mario Draghi is making a very similar comparison, saying that the EU, despite the size of its global economy, isn't actually able to wield the economic power or influence on the global stage that it once used to.
And then Mario Draghi, who of course came out with that Draghi report, to which so many eyes were drawn in terms of the prescription for Europe to get back on its footing when it comes to trade, when it comes to defence. And what he was saying was that we have essentially, and I'm paraphrasing, but struck a raw deal with the US when it comes to that trading partnership, where we accept 15% in Europe and accept, of course, lower barriers in Europe, 15% tariffs in terms of shipments into the US market. And on defence spend, he says maybe that was the right thing to do, but that was under pressure from the US, and maybe the money being put to work in defence isn't necessarily going to be put to work in the places that would be best and done as benefiting Europe the most, because it's coming under that political pressure from the Trump administration. So talking to those vulnerabilities and suggesting that Europe needs to do a lot more work to round out the edges in terms of having its own sustainable footprint going forward.
Yeah. And in that Draghi report, he made that very key piece, quoting Goldman Sachs as well, that 70 to 80% of that defense spend in Europe ultimately gets leaked to the United States. And he was making the case, which has really been the European stock market's bull case here, that the European defense ramp up is coming. This kind of throws cold water on that whole psychology. It's not just the defense story we've got our eye on, it's the tech story as well.
So the national security impetus of this Trump administration, taking 10% in Intel. We've been reporting around this. Now we've had it confirmed, close to $9 billion being invested. It's going to be the subsidies from the CHIPS Act that will be converted into equity for the US government. But this is part of a broader story for this Trump administration that is more interventionist. When you see what they've done in terms of the steel industry, when you see what they've done in terms of taking a major stake in a rare earths company, and of course that policy to take 15% from sales and revenues of Nvidia and AMD into the Chinese market, now 10% in Intel. This is a Trump administration focused on key sectors and, of course, national security. But big questions as to what happens with other chip makers, other industries. Could they be facing a similar purchase, a similar investment from the US government? And is that necessarily good for investors and for the taxpayer?
This doesn't happen in the States. The U.S. government does not take stakes in companies unless you're bailing them out. And even then, it's basically kind of a loan, a one-off. You've seen it with the banks, for example, in 2009. You saw it with, of course, the auto sector and the TARP Act as well. But an actual stake for a company that isn't on the verge of bankruptcy, nonetheless, is very unusual. I know it's more common here in Europe to have kind of government stakes in companies. Commerce Bank is a great example among many, many others. But I think this is so crucial because now you have Nvidia earnings coming in on Wednesday. And geopolitics are front and center with this kind of will they, won't they when it comes to the H20 chips and how much of a piece of that bottom line it makes up.
Yeah, as they look to design potentially a new chip for the Chinese market, there's a question about whether or not China will want those chips, whether the government will allow their companies to purchase those chips, and indeed whether or not the Trump administration will sign off on those export controls or those licenses to allow them to ship into the Chinese market. That could be the risk event. The Nvidia story with those earnings on Wednesday, expectations are always so stretched, but of course it is a gauge in terms of that demand around AI spend. Absolutely.
Will the party stop on Wednesday? We'll find out. Let's tell you what we've got coming up on the show today. Lots of analysis. George LAGARIAS, FORVIS MAZARS chief economist, will be joining the program. We'll see what he makes out of the developments, maybe the tone shift out of Jackson Hole as well. NICOLAS WALEWSKI, ALKEN Asset Management founder, talking to us a little bit about these markets as well. Plus, do you even trade these markets or do you just brace for impact for the seasonality of September? Valerie Noel over at C's Group, the head of trading there, will weigh in at the open.
OK, here's what else to think about through this week then. Today, we, of course, in a bank holiday in the UK. So markets are closed, and enjoy the holiday if you are on one, of course, here in the UK. The German IFO data drops in terms of sentiment survey as well later today. We'll break that for you. On Tuesday, US durable goods, that data giving a sense in terms of course, demand domestically and externally for those US products, as you're starting to get some concern about the tariff pass-through, of course, with the producer prices coming in higher than expected. On Wednesday, of course, it's Nvidia. It's the big one in terms of the earnings pulse and that momentum. Those earnings dropping late in the day, of course, on Wednesday. So we'll be getting a reaction early Thursday for you on that story. And Thursday, of course, on the data front, US jobless claims. So more detail in terms of the labour market of the US. On Friday, though, it's the inflation pulse again. And a reminder that inflation has been ticking up in the US and remains above target. US PCE, of course, it's the favoured gauge for this Federal Reserve and expected to come in at, what, 2.8%? 2.8, 2.9%. 2.9% is the estimate, so just edging up year on year in the month of July is the expectation, Kriti.
Well, the PCE data is so crucial because, as we saw, the CPI data hasn't budged, really. We've seen it in shelter prices. We haven't seen it show up in the nominal price yet. But the PPI data is where that tariff read-through has already shown up in a really big way. And that's the read-through we were expecting PCE. And the markets were more sensitive this time around to the PPI data than the CPI data. And I think that's really crucial in terms of, even if we do get, say, a positive earnings print from Nvidia and everything is great and the party continues, does the party stop then on Friday?
Is this Fed setting itself up for trouble ahead if some analysts and some economists are right, which is that the pass-through of tariffs is going to happen? It's been relatively muted up until this point, but in the second half of the year, that's when the pass-through comes through. The inventories are drawn down. Companies are going to have to start passing on some of the costs to consumers. They've been absorbing that into their margins, but that is not going to be sustainable into the second half of the year, is, of course, the arguments being made. And maybe we'll get a sense as to that story on Friday with that gauge and to what extent that story is starting to adjust.
Yeah, and the timing is really fortuitous here because, of course, in the PCE data, energy is such a big component, and energy prices have been fairly stable despite the geopolitical kind of tug of war that we've seen around the world. So that is perhaps something that will feed into the data as well. I want to point out some of the other stories you need to know this morning. I'm going to start off in the deal space. Keurig Dr. Pepper set to acquire Dutch coffee company JDE Peet for about $18 billion in an all-cash transaction. The combined company will later separate its beverage and coffee operations, effectively undoing the 2018 deal that combined Keurig and Dr. Pepper. And the Trump administration has halted work on an offshore wind farm off the coast of Rhode Island in another blow to the green energy industry. The Revolution Wind project by Denmark's Orsted commenced construction last year and has been stopped as work nears about 80% completion. Moving over to France, they have issued an unusual rebuke to U.S. Ambassador Charles Kushner after he accused French authorities of being lax on anti-Semitism. Kushner, who's the father of President Trump's son-in-law, Jared Kushner, made the accusations in a letter to President Emmanuel Macron. The French Foreign Ministry called Charles Kushner's comments, quote, unacceptable, and say they violate a convention forbidding foreign diplomats from interfering in the host country's affairs.
Coming up, Donald Trump will meet South Korean President Lee Jae-myung for the first time today. We will preview that visit as trade, of course, tops the agenda. Plus, wind energy continues to face blowback from Washington, as Kriti was saying. We're going to check in on those stocks at the open. Up next, markets still digesting the Fed chair's comments at Jackson Hole. We'll get more analysis. If you have any questions of your own for our guests, do send them to us on IB plus BBTV Go. This is Bloomberg.
The stability of the unemployment rate and other labor market measures allows us to proceed carefully as we consider changes to our policy stance. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance.
Fed Chair Jay Powell there speaking from the Jackson Hole conference, making that dovish pivot the market was very much expecting. He's not alone. Former St. Louis Fed President James Bullard saying he thinks there's a case for 100 basis points of rate cuts before next year. Bullard, a contender to succeed Jay Powell as Fed chair, and spoke to us after Powell's comments over at Jackson Hole. Take a listen.
He used the speech to solidify expectations for 25 basis points in September. I was expecting that anyway. Markets were expecting that. He leaned into the most recent labor market report, which was very soft. And so I think that's a done deal. He didn't say too much about beyond that, what you want to do with the October meeting or the December meeting. I have said 100 basis points, going into 2026. So I think you could adjust as you go forward and eventually get a full 100 basis points, but I would go slowly in order to watch the data. And then on the framework review, I'm sure much earlier in the year, they had targeted that they would have the framework discussion and that they would use the Jackson Hole speech to talk about changes to the framework. I thought those were thoughtful and they were well presented in this in this speech, and they're about what many have speculated on. So I think they did about as much as they can on the framework side.
Jim Bullard, Tom Keenan, good morning to you. I definitely consider this my conversation of the day. You served a lengthy term at the St. Louis Fed. You have lived the decline of a greater economy decades and decades ago in the effort to provide for a resurgent St. Louis. As the next chairman of the Fed, whoever that may be, do they have to manage for two American economies, a technology-driven, exceptional economy, and another, to use a cliche, America flat on their back? How would a chairman execute those two Americas?
Yeah, I think income and wealth distribution have become more salient topics for the Fed. It's not that clear how much the Fed can really do. Providing interest rate policy for the whole economy. If you change the rate structure, that affects everyone, not just one particular group that you might be targeting. So I think that's been something we've had to wrestle with, and I've actually done research on it myself to try to understand it better from my point of view. So I think this has been a theme for a while, and that'll be an important theme in macroeconomics going forward.
Okay, former St. Louis Fed President James Bullard speaking, of course, to Bloomberg's Tom Keene, making the case for 100 basis points of cuts through the end of this year from the Fed. Let's check in on the Asian market reaction then. Pick up the baton from the strength that we saw over in the US by the close on Friday. You're seeing a strong session in Asia with the regional gauge up a little over 1%. The strength over in Chinese equities as well being propelled up 1.6% on the CSI 300. The HSI over in Hong Kong up more than 2% as well. Tech leading some of the gains in Asia. We're focused, of course, on South Korea and Japan, meetings there, and then the South Korean president heading over to Washington, D.C. That is a check in terms of some of the enthusiasm filtering through to the Asian markets in the session today. A big week, of course, for Asian earnings with some of the big names like Alibaba reporting through this week. And then Nvidia will have a read across, of course, the Asian session as well when they report later on Wednesday.
Absolutely. It's fascinating to see this kind of celebration, really. The markets are partying on really a confirmation of what so much was getting priced in the lead up to it. Let's get another perspective here this morning. George LAGARIAS, chief economist over at FORVIS MAZARS, joins us this morning. George, a pleasure to have you on the program. Thank you for making time for us. Just give us your initial take about the commentary that came out of Jackson Hole. It felt like Jay Powell did mark this dovish pivot, but did he really, or did he just acknowledge it as one possible solution? How are you reading it?
So, first of all, his words were very carefully chosen, and the markets hear what they want to hear. And I don't think necessarily they're just hearing 25 bips on September. Markets now are beginning to price in, if we're being honest, yield curve control. Okay, because that's the end game here. Okay, it's not just a short-term rate, because you might alleviate some pressure on the short term, but pressure builds up on the long term. Okay, where mortgages are, by the way. So the end game here is yield curve control, and risk markets, especially equities, are beginning to price that in.
You're talking about yield curve control, George, which I feel like kind of kicks the can down the road to August, or sorry, I mean, we're in August, in September, October, when we start to see the X date. How consequential is that when we talk about the debt ceiling in an environment where the Fed is expected now to ease perhaps more significantly than previously thought?
So, again, you can control the short end if you're the Fed, but you can't really do much about the long end. So unless you start printing money and buying long-term bonds, that's yield curve control for you. Is it consequential for the debt? Yes, a lot. Is the debt ceiling really a problem? Well, there have been, 54 discussions in Congress about the debt ceiling since the whole thing began. And every time they managed to raise the debt ceiling, the U.S. doesn't default. Okay, it wouldn't default on a failure to agree something in the Senate or the House. So that's not a huge issue. Okay, that's the way the U.S. has decided to go. It will create probably a sugar rush for markets, okay, which is good for risk assets over the short or medium term. But obviously, longer term risks will now be building up much quicker. And investors should be acknowledging that.
So, George, those risks need to be acknowledged in terms of longer term and the debt build-out in the US. But in terms of that yield curve control thesis that you're drawing out for us, what does that mean in terms of your expectations into next year as to where the Fed goes and how aggressive they are on rate cuts?
Look, again, if we're being honest, we see the Fed's independence somewhat compromised. Okay, that's what we're looking at here. Okay, and that would mean, if you take the 70s as an example, and some exertion of pressure on the Fed to keep the cost of money very, very low, in hopes that this would help growth. So again, this is good for risk assets over the shorter term. For 2026, I'm beginning to be more positive about risk assets. But if I'm looking at the longer term consequences, it's not good for the dollar. And investors should be considering various hedges to their exposure. Again, if you're thinking about the long-term portfolio. But tactically, you should take some advantage.
What would that look like, George? What are some of the hedges that investors might be looking at?
Well, gold is always a good one in those situations. I know it's parochial to say it, but if you're looking at the end or the near end of a classic debt cycle, then that's usually the time to build up some gold, some other precious metals. I'd be on the fence for some other real assets like commodities, other commodities or real estate, in the sense that they can be a little bit idiosyncratic. So you need to be looking more at real assets, because when we talk about yield curve control, also we're talking about the weaker dollar.
George, I want to bring it right back to the tariff story here. A key line that stood out to me when Jay Powell was speaking at Jackson Hole was that this could actually be a one-time hit, and that's a narrative he's been pushing back against for quite some time. What kind of risks do we see in terms of economic policy, not the markets, but the actual real economy of the United States, if that is the wrong take, as in if tariff pressures persist and the Fed isn't preparing for that? What are the consequences of that kind of policy?
So before I joined, we had a very interesting conversation between Tom Keene and James Bullard. Okay, and when we say consequences, we have to be cognizant of one thing. The Fed has one rate. It's a very blunt instrument. And you have two Americas, as Tom Keene very well said. You have the tech America and everything else. And also you have very different inflations. Okay, you have a lot of things inflating right now at 5 and 10%. And you have the housing market, which is deflating. Okay, so yes, headline CPI looks somewhat okay, but actually you have various pressures building up in the end. So I'm going to go out on a limb here and say that the consequences of a wrong call would not necessarily be that great, because the Fed has one rate. Okay, there's only so much it can do with it. And, that would matter a lot more if this was a very leveraged market, but it is not. So economic decisions will have consequences. And the only other tool the Fed has at its disposal to alleviate growth pressures would be money printing. But obviously, this would accelerate inflationary pressures more. Okay, so I think we should, again, go back to the idea of more yield curve control, because the rate, 25 bits, is not going to make a big difference in this environment.
Okay. George, we've run short of time, but we appreciate your insights and, of course, your analysis of what we've been hearing from the Fed. George LAGARIAS, Chief Economist at FORVIS MAZARS, joining us from Athens. Coming up, we're going to take a look at European small caps. As money managers say, a rally in the space is just beginning. Stay with us. This is Bloomberg.
"30 minutes away from the start of the opening trade. It is, of course, a bank holiday here in the UK, but the markets across Europe are very much open. When you look at the futures picture, remember, you are still digesting a lot of the green on the screen over on Friday. There's a rally over in Asia, one that's not really translating, it seems, this morning into European futures. Your Stoxx 50 futures actually taking a bit of a breather, down about 0.4%. It looks like the DAX is the underperformer this morning. we'll see if that sustains into the open. In the meantime, a quick check on the bond market. Of course, this is going to be light volume, light liquidity. It is very much a summer, August Monday here in Europe. But you are seeing yields tick a little bit higher, and that might just simply be following the lead from what you're seeing over in the Treasury space from Friday. However, Treasury market is closed at least during UK trading hours. We look forward to seeing if that changes when the Americans come online.
OK, well, let's get more insight then on the Fed and bring in what we've been hearing from Fed President Susan Collins, saying the September rate decision is not a done deal. She spoke to us at Jackson Hole.
The tariff impacts are significant, and we have done analysis in the Boston Fed, understanding that it's not just direct imports, but the range of goods and services that rely on imported intermediate goods as well. A much broader range. It would surprise many people how many kinds of services actually use imported intermediates as part of what's happening there. And so we are anticipating that over the next couple of quarters, so the rest of this year into early next year, inflation is going to remain elevated. And then my baseline would be it would start to come back down, but I don't rule out a larger and more persistent impact.
But to Mike's earlier point, what is the harm in cutting by 25 basis points or even 50 basis points? Because would that really cause runaway inflation at a time when I know that the chair has talked about policy being relatively restrictive?
Well, it's about the balance, right? I mean, the inflation side, and again, that is what I hear about in every conversation I have across the First District, which is most of New England. And so it's about balancing that commitment to restoring price stability with an understanding that preserving healthy labor markets also really matters for the public. And so doing that balance, I would say it's not a done deal in terms of what we do at the next meeting, but a range of possibilities is on the table, and we're going to get more data between now and then.
Definitely, and everybody out there listening, that's good advice. Wait, don't bet yet. Is it more likely that we see a rapid rise in unemployment, because that tends to be what happens when it starts to go up, or a more long-term but steady rise in inflation that would lead to inflation expectations becoming unmoored?
Well, so from my perspective, the risks on the two sides have come into rough balance. And so that's a really complex context for monetary policy when you could see the unemployment rate rising and you could see higher inflation. You know, my baseline is not one that is as concerned about inflation expectations rising at the moment. Earlier in the year, I had more concerns about that. I would say that at the moment, monetary policy is kind of modestly restrictive. That's actually appropriate for a period when inflation is elevated. We haven't brought back price stability, at which I'm totally committed to. But at the same time, there are those risks with the slower employment growth that could lead unemployment rates to rise, and balancing those risks. So I think at the moment where we are is appropriate. But if we start to see worsening labor market risks relative to inflation, then starting to dial back the restrictiveness would become appropriate.
Boston Fed President Susan Collins there talking to our very own Michael McKee and Lisa Abramowitz over in Jackson Hole. I think it's really interesting what she's talking about there, because one of the key concerns of that extra 25 or the extra 50 that Lisa was kind of prodding about was that does that actually help perhaps the masses actually need it? Yes, it spurs massive economic rallies, but does it show up in the likes of the real economy, small businesses, and even small caps?
And she talks about the fact that those two sides of the mandate for her are very finely balanced between the labour market, of course, and inflation. Let's get a view now in terms of how monetary policy is filtering through to some of the equity story, particularly the small caps. We've heard from European central bankers as well. Joachim Nagel saying he sees a very high bar for further cuts from the ECB, with rates, of course, at around 2%, and they're meeting that 2% inflation goal, of course, the ECB, unlike the Federal Reserve. In terms of the small caps, there's been a lot of focus on the MDAX over in Germany with those fund flows, of course, in terms of defence stocks. Let's get a view right now. ALKEN Asset Management delivering incredible returns. NICOLAS, WALEWSKI, founder of ALKEN Asset Management, joins us for a view specifically on those small caps. And NICOLAS, the fund has outperformed. I guess a question for our audience is, given where monetary policy settings are right now in Europe and the US, is the door still open for further exposure to the European small cap story, or is that starting to close? Good morning.
Good morning, and thank you very much for hosting me this morning. Yes, I think the European small caps have done very well so far this year, but I think this outperformance has legs. First of all, you have robust earnings growth for the European small cap index, around 13%. And if you're a good selector, should do better than that. Sorry for the noise. Second, we have very attractive valuations. We have European small caps trading, as you show on your graph, at a significant discount, one of the largest ever. It was a bit higher at the beginning of the year, but still very significant. Third, we have a strong resilience because only 11 to 12% of revenues on small caps are exposed to the US, whether compared to around 24% for large caps. And you have an increasing fiscal spending, notably in Germany with the 500 billion fund. You have the ECB cutting rates and most central banks around the world probably cutting rates. You can see as well that the rally technically has been healthy, it's broad-based, with more than half of micro and small caps trading above their 100-day moving average. You've seen inflows coming back for the first time in a very long time, and I think that's very very encouraging.
What assumptions, Nicolas, are you making about the fundamentals of the Eurozone economy into 2026 with that positive view on European small caps?
We don't have to be very aggressive. We take the consensus view for very minor growth, supported by interest rate cuts and these stimulus programs, and that should be enough. That should be enough. You have to remember that the activity has been very slow for 3 to 4 years, so all these companies have been very cautious on cost, on managing their margins, and we see rising backlogs.
Nicolas, it's Kriti in London. One of the cases against betting on small caps right now is simply that if there is a persistent tariff threat on either side of the Atlantic, it's the bigger companies with larger liquidity profiles, larger cash cushions that can weather the storm better. Is that something that the small cap space is prepared for?
Well, we focus on a lot of small caps that are investing, that are focused domestically in defense, in construction, in real estate, in financials, and so I think these small caps are very much protected from this war. Of course, there are some small caps because it's a diverse universe that will be exposed to US tariffs. It could be in luxury, it could be in spirits, it could be in capital goods, but we're away from most of these stocks.
So, Nicolas, and you make the point that a lot of the bull case for small caps rests on that fiscal spend that's coming from Germany, the broader European story as well. There is a question, however, specifically in the defense sector, which you just outlined as well, that perhaps that fiscal spend doesn't come through in its entirety. Is that possibility priced into the market?
Well, the market has been cautious so far. We shall see. I think the market is anticipating a rise in fiscal spending for the next 2 to 3 years, and we shall see this essentially in 26. We haven't seen much in 25 because it takes time for these measures to go through parliaments, to be voted into laws and so on, and to be implemented. So we expect that to happen in 2026.
And that ties in, of course, to what we're seeing on defence, Nicolas, which is a sector that I know you favour. Where within the defence basket do you want to be positioned right now?
Well, I think you want to be diversified. Initially, we wanted to be more exposed to things like ammunitions and hardware. We still want that, but we want to be maybe more to some more long-term beneficiaries, companies that will benefit from the switch to drones, to artificial intelligence, the war of robots we're going into, and I think there are some companies that will benefit from those trends.
Nicolas, I want to take a kind of massive zoom out, if I can. Where are, to the clients that you're speaking with, the money that you're managing, the investments that you're making, do you see or do you feel like you're in the consensus here that fund flows, global fund flows, favor small caps right now?
I don't know if global fund flows favor small caps. What we have seen for us and a few others in Europe is that for 15 years, we only had outflows. Investors were favoring various asset classes, and even in the last 3 years, they were favoring ETFs when they were investing in Europe. So in active fund managers, we've seen flows only this year really coming back. So I think it's the first time in 15 years. So I think there's a lot more room to go. And coinciding with the picture I've showed you, the fact that the small caps are cheap, trade at low multiples, they have strong backlogs, rising EPS. I don't see that as I feel very comfortable.
We look forward to seeing if that bet ultimately pays off. NICOLAS WALEWSKI will leave the conversation there, founder of ALKEN Asset Management, joining us this morning. We thank you so much for your time. Less than 20 minutes away from the opening trade, we're going to keep an eye on one stock, Trump, knocking the wind out of Orsted sales. We discussed latest hitting the renewable firm in our stocks to watch and perhaps a ripple effect from that policy decision. Stick with us. This is Bloomberg.
When I appeared at this podium 1 year ago, the economy was at an inflection point. This year, the economy has faced new challenges. Significantly higher tariffs across our trading partners are remaking the global trading system. Tighter immigration policy has led to an abrupt slowdown in labor force growth. There is significant uncertainty about where all of these policies will eventually settle. While the labor market appears to be in balance, it is a curious kind of balance that results from a marked slowing in both the supply of and demand for workers. The effects of tariffs on consumer prices are now clearly visible. We expect those effects to accumulate over coming months with policy in restrictive territory. The baseline outlook and the shifting balance of risks may warrant adjusting our policy stance.
Fed Chair Jay Powell, they're talking about the many cases, the many new factors they now have to consider when it comes to the U.S. fiscal policy and immigration policy coming from the Trump administration, how that reads into their monetary policy stance, something that is widely being interpreted by the markets as a new and fresh openness to a cut as early as September. So what are the market implications here? And I thought this was really interesting over the weekend, seeing a lot of the analysis and the fallout from Jackson Hole, simply this idea of whether or not the bond market is actually taking that in full stride. This equity market rally, they're throwing a party. The bond market seems to still be fairly range bound. But for me, this is the chart that caught my eye over the weekend, pointed out by Jens Nordvik over at Exante Data, that the correlation between the dollar and treasuries is starting to build back up. And this is something that was out of sync for a while. You had the U.S. 10-year in a range about 420 to 460 and kind of staying within that range as the dollar continued to weaken and weaken and weaken. And you can kind of see that dynamic in these lines here. They were really starting to trade together tick by tick as they do historically. And that correlation did kind of break down until the last couple of months. Really Liberation Day, I have to say, after Liberation Day, that started to come up, but only became statistically significant recently. We're not about 0.6 when it comes to that correlation. I think that's really, really crucial when it comes to whether or not the dollar is taking its cue from what the bond market is pricing in. Because if you start to think about more rate cuts, does that actually eliminate any case for more dollar bullishness? And that's going to be really key when it comes to this idea of whether these cross-asset correlations are indeed actually correlated the way that they have historically been, or this is just a completely new world and a completely new dynamic. I want to get a true expert's opinion on this. Markets Live executive editor Mark Cudmore is joining the program for a traditional 3 minutes. Mark, your take on that. We've talked about rates and the dollar kind of pulling apart for quite some time. They start to be coming back, or they seem to be coming back together. What do you think the reasoning for that is?
Yeah, I think we had a temporary dislocation earlier this year. We obviously had quite a unique environment. Suddenly, trade policy became the most important driver of global markets, which is not something that I remember kind of seeing before. And it wasn't just a one-off shift, because obviously it was extended periods of uncertainty. The uncertainty hasn't fully gone away. We've gone past the worst of it. So I think there was a big dislocation between FX and rates temporarily, and I think rates is reasserting its role as being one of the most important drivers. I wouldn't want to emphasize that it's going to completely dominate the story. I think the fact is we're seeing ongoing undermining of US institutional credibility, and I think that given that the world is still structurally exposed to the dollar, I'm not talking about short-term money which is short the dollar, I'm talking about the long-term exposure to the dollar. I think that'll continue to weigh on the dollar over the coming years. It's an expensive currency with a current account problem and a fiscal problem, and those twin deficits will weigh in it over the coming years as institutional credibility continues to get undermined.
So those credibility risks are still there, particularly when you push out to 2026. Mark, what do you make of exactly what we heard from Jay Powell and the equity market reaction as well? Strength, of course, in the US session. Looks like it's fading a little bit today. Is this a market that's expecting one and done in September, or is there something else at play?
So I think Powell, if you read his comments, from, if you came in from outer space and did not have the prior pricing, you'd go, these are pretty neutral comments. We may warrant a shift in adjustment in policy. I think that in the context that we are pricing most of a rate cut going into the speech, it was correctly taken as dovish because he didn't push back on the pricing. Here was a chance to kind of go, whoa, whoa, whoa. People have got carried away for the rate cut meeting, for the policy meeting in a few weeks' time. Maybe that's a Freudian slip. And therefore, he validated pricing for a rate cut. And therefore, it was a dovish shift. Now, what's interesting today is we're not seeing any follow-through price action. I think the price action is actually very disappointing, which is getting a little bit of a new narrative out there in the market. I think the narrative is coming from the price action, kind of going, you know what? It's no real different from a week ago. We knew that a week ago it was really the data in the coming weeks that were going to decide things. Now we still know that today. The slight shift, and there has been a genuine shift, is a week ago it was, I will cut rates if the data really validates that decision. Now it's, I'm going to cut rates unless the data prevents me from doing so.
Well, speaking of the data, we have jobless claims on Thursday. We have US PCE on Friday. Does that move the dial at all?
Yeah, look, I think inflation in the coming weeks is very important. I think the more important is the CPI one, actually, in 2 weeks' time. I think non-farm payrolls, given the large revisions we had before, are really important. We've got some more adjustments coming up, kind of long-term adjustments coming up. So, yeah, look, I think non-farm payrolls and CPI are more important. But obviously, yes, even this week matters. And Nvidia price action is going to matter as well after probably strong earnings.
OK, those earnings dropping late on Wednesday. Bloomberg Markets Live, Executive Editor Mark Cudmore, thank you for the analysis. Of course, you remember you can get up-to-date takes and insight from Mark and the rest of the team. Just go to MLIV. Go on your terminal. Let's get some stocks to watch right now with Louise Moon. Louise, standing by. What are you watching for?
Morning, Tom. So the big story that we're watching for this morning is Trump and wind, which seems to kind of never go away. And the main one we're really looking at is the Danish wind company Orsted. So the news over the weekend is that Trump is planning to halt work on one of Orsted's wind farms off the coast of America. It's been in crisis mode essentially since Trump came into office. So when he first came in, shares slumped again in around June when there was a change to tax policies. And we're expecting this could, happen again this morning, down in pre-trading this morning. As well as that, on the back of that news, one company also cut its rating on Orsted. So if you take a look at the analyst ratings, most are holding, a few cutting, and even less are buying. So cut by Clarkson's down this morning. So that's the main one that we're watching for. The next one we're watching for this morning is JD Peet, the Amsterdam-listed firm. They're being bought by Dr. Pepper for $18 billion. If you look at their share price, they've been on a real tear this morning, so a good deal for Dr. Pepper. Their coffee business has been struggling, and JD Peet has been outperforming. It's been doing really well, as you can see from their share price. They're also expecting to do even better going forward. So they're forecasting about a 1 to 3% growth going forward. That's in profit and also in adjusted EBIT. So positive news for both Dr. Pepper and JD Peet. They're also up in pre-market trading this this morning. And then finally, just the last one that we're really focusing on, a quick note on two German lenders. So UniCredit has boosted its stake in Commerzbank to 26%, takes its overall equity stake to about 29%. Both have been, if you look at a comparison of both their share price over the past year or so, both been doing well. This was expected, so we would expect minimal reaction this morning, but positive news for UniCredit there.
Louise Moon walking us through some of the stocks to watch. We thank you so much. Of course, it is a bank holiday here in the UK, so the FTSE is not trading. U.S. Treasuries are not trading, and gilts are, of course, not trading. But the rest of the European market is open, although perhaps going to see quite a bit of light volume and light liquidity. We should remind our audience, though, Tom, that the market did rally on Friday, kind of following the lead of the States as well. So it's only natural to see a little bit of a pullback when it comes to the futures picture this morning.
Within the context, of course, so you had 5 straight days of losses for the S&P 500, making up for some of that, of course, on that rally that you point to on Friday. The Nasdaq performing very well, the Russell 2000 as well, the small caps rallying almost 4%. But to Mark's point, we're not seeing a big pickup in terms of the European equity story on the back of this. So it seems that there is caution there in terms of the steps ahead. We look for the next data and then where we go beyond September.
Absolutely. And I think you in the last hour had made the point that September seasonality is going to be a massive risk that perhaps the market is bracing for. The last few years, 2024 aside, have not been a pleasant experience for traders who have been pricing in some sort of bullishness in September. So do we get that reality check as soon as next month? That's something to be discussing in the next couple of weeks. Coming up, though, it is the opening trade, 5 minutes away. Futures, as we said, taking a little bit of a breather across Europe. It's a holiday right here in the UK. Stick with us. Lots of individual stories to dissect, though. This is Bloomberg. A few minutes to go until the opening trade. Now, the UK markets are closed today, but the European markets are very much open. I think it's important to look at the last 24 hours in trading before we dive into the next 24. This is how we ended Friday. This white line, of course, is the stock 600, and you can see them following that rally that really got spurred by the dovish pivot, or at least what everyone interpreted as a dovish pivot out of Jay Powell over at Jackson Hole. And the market stayed in the green, at least when it comes to Europe and, of course, in the States, which means we're maybe set up for a little bit of a pullback. You can see that in the futures picture already, despite the fact that, of course, the UK market is closed. It's an August Monday. It's a summer August Monday in Europe. So light volume, light liquidity, and yet the markets are pulling back, especially when you go look at the DAX, Tom, down about 0.6%. The underperformer of the morning, at least going into the trade, seems to be Germany.
Some of the individual stocks that we can expect to possibly be on the move in focus for us right now. Wind stocks in focus. This on the news that the Trump administration has paused work on a key project, of course, in that country, focusing on Orsted. Pre-market, you're looking at a print of losses potentially around 12% for Orsted. So that company is in focus. Some deal making involving JD Peet's, of course, listed over in the Netherlands. This is a bid by Keurig Dr Pepper, worth about 18.4 billion. So Peet's, of course, could move on the back of that story. And Equinor on the news that it's made a oil and gas discovery near the Framlin field in the North Sea. So watch Equinor as well on that story. Kriti.
Yeah, it's a fascinating one because there's a lot of individual stories, a lot of deal making that's happening underneath the surface. Doesn't get priced into this market, though. We have UniCredit and Commerzbank to watch as well as we start to see a larger stake getting built up into Commerzbank. Do we see that bubble up to the top, especially for a DAX that is so weak this morning going into the futures picture? Light volume, light liquidity going to permeate this trading day. Let's get these markets open. Of course, a UK bank holiday right here in London. So worth keeping in mind that, of course, you don't have the UK traders at their desk, but the stock 600, we are still properly waiting to actually open again. Light volume, light liquidity seems to be the name of the day, and taking a little bit of time, I say, to actually open up. The stock 600 taking a little bit of I'm not going to call it a beating, but perhaps not a massively positive open. The IBEX down about 0.4%. I think we can call that a beating as well. Perhaps setting the tone for some weakness across the European markets. The FTSE MIB down about 0.4% as well, and the CAC 40 down about 0.3%. I think the big one that we're going to be waiting for, of course, course, the DAX. We'll let that for a few minutes kind of bubble up to the surface, because going into futures trading, Tom, that's where the pain point was.
Yeah, look, counterintuitive trades on some respects, given that the markets had not arguably been positioned for a pivot, a dovish pivot, if that is how we characterise it from Fed Chair Jay Powell, of course, on Friday. And yet you had European equities close to and notching up fresh record highs last week. So that is part of the context, maybe a bit of profit taking and waiting for the next catalyst. In terms of your sector moves then, right now you're seeing travel and media, the two sectors eking out very slim gains so far on the Monday session. The downside, the pressure coming through for construction, utilities and telecoms right now. Losses of around 0.4% for those sectors. Every sector in negative territory then, apart from travel and leisure and media. Travel and leisure up just at 0.2%, Kriti.
Yeah, it's a fascinating one that we are actually seeing some spots of green, though. So there are places of relief, perhaps, in this market. When you look at the individual movers, right off the bat, again, light volume, light liquidity is something we have to preface in everything here. Novo Nordisk is part of the members that are showing a little bit of green on the screen, higher by 0.7%. It is your biggest index contributor to the upside, but I think that kind of movers screen on movers graphic on your screen shows just how maybe light volume and light liquidity this actually is as well. I want to talk about Siemens here, because that's where you are seeing quite a bit of pain in terms of the weight on the stock 600. Siemens Energy down about 1%. And again, we are still waiting for the DAX to open, but this is perhaps one of the stories that could be weighing on the index as a whole.
We're watching for the wind companies, of course, and you're seeing a print coming through for Vestas, down 3.8%. Again, on the news that the Trump administration has paused the build-out of one of the key wind turbine projects led by Orsted. We're still waiting for a print on Orsted, and we know, of course, they've been called lower by almost 12%, but you are seeing some of its counterparts under pressure on the back of that story. Some of the gainers coming through right now. We talked about Novo, but also Delivery Hero gaining 2.5%. That is one of the gainers. Across your sectors, it's still just travel and leisure and media that is eking out gains. Of course, the FTSE 100 is closed for the bank holiday, but you're seeing pressure over in France. The currently down 0.4, and some heavier selling, as Kriti was mentioning, over in Germany, with the DAX down 0.5.
We're certainly going to watch and see if some of this price action sustains. In the meantime, let's get a true expert joining us at our program this morning. Valerie Noel, head of trading over at Seas Group, joins the program. Valerie, Tom and I have been debating this concept of, now that we've seen the markets maybe embrace where Jay Powell's dovish pivot is, or maybe even feel a little validated from him acknowledging the possibility of a cut as soon as September, where does this market go next? Is it all down from here, whether or not we get a rate cut in place? Your view?
Well, I think, first of all, thank you for having me. It's true that the rebound was very powerful in US, 800 points for the Dow Jones, 4% for the Russell 2000. But I think it's more a relief rally than real pivot. I think people need to be in cautious mode until the next Fed meeting. The Fed's going to watch very carefully the inflation data and the job reports. So that's going to be the next step.
Well, as Valerie, I'm just going to put you on pause for 1 second. Just recognize the fact that Orsted is open and down, really suffering, down about 17%. A lot of that coming out of a policy change over in the States when it comes to their offshore wind policy. Valerie, let me put that question to you, though, when it comes to actually interpreting policy decisions out of the United States. We spent a good chunk of this year talking about trade policy. Is that still going to permeate the conversation into the back half of this year?
Well, we can really see that every time Donald Trump opens his mouth, there is something happen for the market. And we still have these uncertainties on every sector. And I think we need to take one by one everything will happen. And I think the market's gonna move around all the news we can hear everywhere.
Valerie, as we think about the Fed and what we've been hearing from Jay Powell and the changes that the Trump administration wants to make to this institution, do you want to start to price for a more dovish and a more pliant Federal Reserve in 2026?
Well, I think, for the Fed, it's between inflation and the job, there is this thin balance. They got this dual mandate. Employment for the moment is weakening. Job creation is slowing. So the Fed must act before the labor market deteriorates too quickly. So it's going to be, I think, as Joe Powell said, it's going to be step by step. He really wants to be independent. He said very loud. So it's on process, but I think it's a very difficult time for them for the moment between the inflation and the consumer need to spend money in US, but we also have the tariffs. So I think there is a lot of challenge for the administration of Trump.
Sure. I mean, the here and now, and the focus clearly is on the balance between the labour market and inflation. But we've seen every institution in the US be moulded and shaped to some extent by this president, by President Trump and his administration. And it's hard to imagine a world in which the Fed does not feel that impact. And so I'm really trying to get at whether or not 2026 really rewrites the script in terms of this central bank for investors.
Yes, I mean, also they're going to have the change of Powell next year. So for sure, they got a lot of pressure. I think Christine Lagarde was saying this weekend that independent of a central bank is very, very important. And but I mean, who knows? I believe that next year, probably, the administration of Trump will try to involve a bit more and more on the Fed. But I think the independent, it's very important everywhere in the world, actually, not only in the United States, but maybe more in the United States than in Europe for the moment.
Valerie, you mentioned Christine Lagarde, so it's only natural to dive into or zoom into Europe a little bit more. It feels like the bull case of the last 6 months, at least, when it comes to Europe, has one been U.S. exceptionalism and the perceived end of it. And the second factor has been this massive expected defense ramp up in fiscal spend. If we do start to see a ceasefire or signs of a ceasefire in Ukraine, which admittedly feels far off at the moment, or we even see some of these defense contracts ultimately leaking to the United States, how bullish can people really be on Europe?
Yes, well, even if also the Fed's going to start to lower the rates, is going to be for Europe and Switzerland. It can be also good for all our exporters. But I think we have this productivity gap with United States. So I think you cannot avoid US at all. Actually, at the bank, we really like US, but you need to be diversified. And I think that's the word. When you manage portfolio, you need to be diversified, not only US, but Europe, Asia, China. We are also very positive on the China emerging markets. And I think the big word is to be diversified and to pick up the right sector.
Valerie, does the currency component matter anymore? It feels like the dollar has resumed its slide. I'm looking at euro dollar of 117 this morning. If we can see continued weakness in the dollar, is that a sign for global investors to buy America or sell America?
To keep America, for sure. But I think, for exporter, for Europe, it's also good. The demand will be here, but in another way, you're going to face this FX not issue, but it's take it or leave it. You have a better demand, but then you need to match with your own currency. So I don't think it's one country or one currency to the another one. I think you really have to be diversified. The dollars is where it is. It's been really, really down the first part of the year. We had little rebound, I would say last week or 10 years ago, due more by hedging position than having a bet on the dollars coming up. And then obviously if the Fed's going to lower the rate, you're going to have pressure on the US dollar.
How do you think about Nvidia's earnings, Valerie? How are you positioning around that? Is that the next risk event for these markets? Do you see that as the next catalyst? Are you convinced that the AI theme has further to run in the US?
Yeah, definitely. It's definitely the next catalyst. It's the catalyst of this week, I have to say. So it's Wednesday. I think everyone is waiting. I don't think you need to really avoid, Max 7, even if the results are not what we expect. But maybe, what we do at Bank Seats, it's maybe watching a little bit more the S&P equal weight than the S&P where the concentration of the Max 7 is very, very high. And yes, it's going to be definitely a very, very strong news for this week.
You touched on China, which I thought was interesting, because we had a piece on the Bloomberg terminal today talking about concerns around a bubble in China. The Shanghai Comp, of course, is up around 20% since April, about $1 trillion in market cap being added across Chinese equities, and yet the fundamentals of China remain strained. How do you play that story? Do you want exposure to A shares, H shares, or in fact, companies and corporates have exposure to the Chinese market? How are you thinking about playing China?
We try to Sorry. We try to avoid stock picking. We like to trade via ETF or fund, quite diversified. Same on emerging market, but for the moment we're still a little bit overweight on a China and emerging markets.
All right. Valerie, talk to us a little bit then about where the risk event actually is. I mean, I know we're talking about Nvidia, I know we're talking about these macro trends, but for you, what is the market underpricing right now and not paying attention to?
The overconfidence. I think the market is reacting very, very quick on a lot of things. And also, you know, we've seen all these retail investors, they put money since in the last 16 weeks, they put 1 billion inflow every day. During 14 weeks. So it's just last week, they pulled out 140 million, I think it was last Tuesday. But it's just to show that the market is full of liquidity. And I think one of the risks is that if the liquidity is going back, what's really is going to happen? And we are coming in September in seasonality, on average, normally the S&P lost 1%. And normally the volatility is increased by 25% in September. So let's see if this year it's going to be the same. But I think one of the risks is this liquidity who fuel this market. What's going to happen if the liquidity is going to go down?
All right. Valerie Noel, head of trading over at Seas Group, joining us this morning for her insights. We thank you so much. Let's take a quick check at some of the heavyweights that drive the European trade. The core six, of course, the Guy Johnson core six, is I think fair to call it. Novo Nordisk is going to be the highlight here, down about 0.1%. It was higher, and it was your biggest index contributor to the upside. So the fact that those gains have been paired fairly quickly in just 12 minutes into trading, I think is fairly notable. Rheinmetall, fascinating, higher by 0.7%. ASML also getting a little bit of a bit higher by 0.1%. But the rest of this market taking a breather. Let's get a check of some of the individual stocks also on the move. Louise Moon has that for us this morning. Louise.
Hi, Kriti. So wind is really being hammered across Europe. So down in the red, we've got Orsted, the Danish company, down almost 18% at open, and Vestas over 3% also in the red. That's obviously after the Trump administration cancelled one of Orsted's wind farms off the US coast. Next up, we're looking at JDE Peet, Amsterdam-listed company. They're being bought for about $18 billion by Dr. Pepper, up over 17% on that news. So stock really soaring, adding to gains that we've seen so far this year already. Next up, we've got the Swedish manufacturer Thule. They've down almost 5% into the red this morning. That's after they've been downgraded to a sell from a hold. And then finally, we're looking at Delivery Hero. We'll have a look at their price right now, up over 2% into the green. That's ahead of their earnings. Their earnings are in a couple of days on August 28th. So some profit taking there.
Louise Moon, thank you very much indeed. And from some of the stocks on the move, some big moves as well coming through. The deal making around GDPs, as Louise was saying, and of course Orsted, and the policy uncertainty around renewables out of the US taking a big hit to the wind makers as well. The wind stocks, of course, on the back of that story, as Louise was saying. So, Kriti, we are broadly across the benchmarks seeing a little bit of softness with the point, as you've made and you've stressed, that there are going to be slimmer volumes in the session today, given, of course, that the UK is closed for a bank holiday. Nonetheless, it may be surprising to some that European stocks are down 0.3% across the benchmark.
Yeah, it's fascinating as well, because I wonder how much of this is just bracing for the real action, which is later this week. It's coming from Nvidia earnings, it's coming from the PCE data as well. And perhaps that's why you see a little bit of taking cash off the table ahead of that seasonality we're expecting next month. Yeah,
is this a market that still wants confirmation, wants the data to really align with the gap that's been opened up now by Jay Powell to really lock in as markets price in 85% chance of a September cut. Two cuts still being fully priced by the end of this year. The ECB and officials there, particularly in the hawkish end, have suggested that they are in no mood to cut again. The bar is very high. European stocks currently a little softer by 0.3%. US futures, S&P evenly, just down 0.2, but after the rally, of course, on Friday. Coming up, the Trump administration has halted work on Orsted's offshore wind farm off the coast of Rhode Island, as Louise was saying, in another blow to the green energy industry. We'll get more details. It's been a turbulent time for Orsted. Stay with us. This is Bloomberg.
Welcome back to the opening trade. About 18 minutes into today's session, and we're starting to see a little bit of a weak risk picture. The stock 600 down about 0.3%. The DAX is your notable underperformer, down to the tune of about 0.5%. The CAC down about the same margin. Let's go to one of the major stock movers that we've got this morning. Shares of Orsted taking a beating this morning, down some 17% at the open. This all comes as the Trump administration orders a halt to work on Orsted's offshore wind farm off the coast of Rhode Island in another blow to the green energy industry. Let's talk more about this. Christian Weinberg, Bloomberg's breaking news editor, joins us from Copenhagen. Christian, we thank you so much for your time this morning. Can you just walk us through what it actually means for Orsted and the industry?
Well, as you say, it's another blow for the industry. There's been a lot of bad news for the wind industry for a long time, and this shows also how, to what extent that the industry is still vulnerable to the Trump administration's opposition to wind turbines. There had been some hope that the industry would be shielded from the worst of this opposition at the local state level, but this presidential stop order shows that Donald Trump will go far in his crusade against the industry.
Yeah, I mean, and investors in this stock have had a wild ride, haven't they? They've been whipsawed because there were the tax changes that were seen as beneficial to Orsted, and you saw a rally on the back of that after, of course, the concerns about the Trump administration. Now, a reminder that the Trump administration has really very little time for this renewable energy. Orsted also confirming its commitment with this planned rights issue. That was another element, of course, that moved the stock pretty heavily a week or so ago. What do we know about the confirmation today, then?
Yes, this is a key for Orsted to raise money to bolster its balance sheet. And this was, as you said, about 2 weeks ago that they announced that they would sell about $9 billion worth of shares in a rights issue. They're saying today that they're committing to go ahead with that plan. And crucial for them is that the Danish state has pledged that they should go ahead. The Danish state owns 50% in Orsted. So that's crucial for Orsted. Now, the only thing is that with the share price falling another, 16 or 17% today, that rights issue is going to be a lot more tricky than it already was.
Well, Christian, how much should we be reading into the broader renewable industry from what's going on with Orsted right now? Is this a company-specific issue, or is this something that could be the canary in the coal mine for Vestas and others?
Well, I'm sure that Vestas, the turbine producer, investors in their stock, they're also concerned this morning. The shares also falling. This will obviously have a ripple effect. There's also hope that the project will still go ahead and that this is just a bump in the road. But there are a lot of bumps in the road for the industry right now. The Nordic region in Europe here is particularly hit because the region is home to a lot of companies. Some of them have gone under. You might remember Northvolt, the Swedish battery maker, for example, also part of the green transition industry. So there's been a lot of bumps in the road. There's also a lot of support, though, a lot of money flowing into green assets in the past years. So, but it is a challenging time for the industry.
OK, Christian Weinberg, Bloomberg's breaking news editor, thank you very much indeed. As we continue to monitor, of course, the share price action for Orsted and other players within the wind space. Orsted currently down 15.6%. To a very different story and very different outcome right now, because JD Peet is soaring on the back of news that Keurig Dr Pepper is said to be close to a deal to acquire the Dutch company, coffee company, of course, for about $18 billion. That stock up 17% right now. As you can see, sources say a deal could be announced as soon as today. Let's talk to Bloomberg reporter Charlotte Hughes-Morgan for the details. Charlotte, what do we know about this potential deal?
That's right. Well, in fact, I can tell you that the deal has, in fact, been confirmed. So today, this morning, we just had a release through, and Keurig Dr Pepper have made an offer for JDE Peet. The offer values the coffee company, which bills itself as the world's largest pure-play coffee company, at 15.7 billion euros. That is around $18 billion. And this is a really transformational deal for Keurig Dr Pepper. In the release, they say once this acquisition has gone through, there are plans to separate the company into two publicly listed companies traded in the US. So you'd have, on the one side, a global coffee company focused just on coffee, with that addition of JDE Peet's kind of global coffee portfolio. And then on the other hand, you'll have a soft drinks company, so just focused on non-alcoholic beverages, including obviously Keurig Dr. Pepper's very popular Dr. Pepper brand. So you're going to have this huge transformation in the company following the closure of this deal, which is expected to close in the first half of 2026.
Well, Charlotte, can you just explain to our global audience the logic of restructuring the company to do that? Why pursue that now?
It's a good question. And so for context, in 2018, you had a merger between Keurig, the coffee coffee side of the business, and Dr. Pepper, which is obviously focused on that soft drinks unit. And since then, the soft drink side of the business has really been outperforming. Consumer demand remains really strong. But the coffee side of Keurig Dr. Pepper has struggled. It's faced increased competition. Coffee companies around the world, and this includes JDE Peet, have really been grappling with record coffee bean inflation. So the price of coffee has really been kind of going through the roof. That's obviously squeezed margins at coffee companies around the world. And finally, more recently, you have the impact of tariffs, which are obviously kind of increasing the price of importing coffee into the US. So the coffee side of the business has really been kind of struggling to compete. There's lots of competition in that market in the US. And so the rationale behind this deal is basically to add JDE Peet's huge geographical footprint. I mean, they own brands like Law, they own the Peet's coffee brand, they own Jacobs, Stout Egbert. So to add that to the coffee side of the business, make that into the world's kind of global coffee player. Meanwhile, you have the soft drinks part of the business, and that can really be, you know, unleashed to soar without the kind of coffee unit addition. So the rationale is really to kind of capitalize on the strength in the soft drinks growth, whilst making this kind of coffee whale, if you like, of a company.
Coffee whale of a company. One of the stats that jumped out for me, 132 billion cups annually is what they claim to serve JDE Peet's. So you're talking through the restructuring there, Charlotte. What does it mean then for JDE Peet's?
Definitely. I mean, this is a really interesting company. I mean, it's Amsterdam listed, but it bills itself, as I said, world's biggest pure play coffee company. And in November, they had a new CEO announced, Rafael Oliveira, and the shares have really been on quite a tear since he joined. He pledged to streamline the operations. He divested some of the less strongly performing parts of the business and the tea side of things, and he's pledged to kind of focus on the key brands, so Jacobs and also the Peet's coffee chain. So really kind of focus on optimizing the strength in their markets. And before that, actually, the company was struggling. You know, IPO'd in 2020 to great fanfare, raised a huge amount, 2.5 billion, I think it was, on its listing day. Really enormous listing, but since then it struggled to maintain momentum. So hopefully, I think the rationale is to kind of boost JDE Peet's by combining it with Keurig, and hopefully this will create this kind of global coffee company.
All right, Charlotte Hughes-Morgan walking us through the biggest deal of the morning. I think fair to say we thank you so much. Coming up on the program, right back to the commentary from Jackson Hole. ECB's Nagel saying there's a high bar for another rate cut. We're going to get back to that conversation next. This is Bloomberg. Welcome back to the opening trade. 30 minutes into today's session, we are seeing red on the screen. The underperformer, of course, is going to be in Germany. Siemens Energy and SAP really not helping the story for the DAX, but you're seeing that weakness across the board. A couple of deals to keep in mind as well. We're looking at JDE Peet's. We're looking at the Keurig Dr. Pepper bid there. We have Orsted and some policy changes there, which has kind of been the weight on the market this morning. But the rest seems to be light volume, light liquidity, maybe a pullback from the rally, Tom, we saw on Friday. Here's what else you need to know this morning, then, as we look at that pullback in terms of some of the geopolitics and some of the questions around the tech space. US President Donald Trump has sealed a deal that has given the US government a nearly 10% stake in Intel. The move comes as the US administration seeks to reinvigorate the company and boost domestic chip manufacturing. Canadian Prime Minister Mark Carney visited Kyiv on Ukraine's Independence Day, pledging support for as long as it takes. Speaking alongside President Volodymyr Zelensky, Carney said peace with Russia must come through strength and did not rule out providing Canadian peacekeepers. Canada also announced over $1.4 billion in military and reconstruction aid.
The Federal Reserve's Jackson Hole Symposium was a tense affair, with Chair Jerome Powell signalling an interest rate cut as soon as the next policy meeting in September. Despite clear divisions among policymakers, the chairman noted the economy has handed Fed officials a challenging situation.
It's about balancing that commitment to restoring price stability with an understanding that preserving healthy labor markets also really matters for the public. And so doing that balance, I would say it's not a done deal in terms of what we do at the next meeting, but a range of possibilities is on the table, and we're going to get more data between now and then.
And certainly one view from Susan Collins, plenty of others across the conversation with Bloomberg Television and Radio on Friday in Jackson Hole. It's fascinating because you are seeing that range of outcomes really widen. I'm starting to get a little bit of deja vu from the conversation you have here, even in the UK or in Europe, where not everyone's on the same page when it comes to how easy it is to interpret some of the inflationary concerns.
And Jay Powell did leave himself some optionality. I don't think you can read into the statement and the speech that he gave and think that if the data doesn't align with the view that they have the space to go in September, that he doesn't have the option possibly to pause. Markets, though, are pricing in more than 80% chance that they do go in September. Our MLIV team, Mark Cudmore, or in fact, Mark Cranfield, was saying you should assume it's essentially locked in at this point. We do have more details in terms of the data coming through, though. The PCE gauge, of course, on Friday, and what we have on the labour front, US jobless claims. And he talked about the labour market being curious as well in the US, with softer demand for workers, but also weaker supply as well.
Are the markets doing the heavy lifting here? As the Fed stays on the sidelines, are the markets driving the charge? And I feel like I'm having a little deja vu from conversations in 2022 where the markets started pricing in hikes far before the Federal Reserve did. But I am curious if that's what's happening in terms of the real economy effect that you're starting to see with all these cuts kind of priced into the market.
There was a read across as well, of course, in terms of what we heard from central bank governors from other parts of the world. We heard from Governor Ueda over in Japan. They have a very different set of problems, of course, an expectation that maybe they go again with a hike, possibly in October. But we also heard from the ECB officials, Christine Lagarde giving an interview, interestingly, to US media, but also Joachim Nagel, clearly, historically, traditionally, on the hawkish end of the spectrum.
Absolutely. And he stated that the European Central Bank would actually perhaps need a significant shift in economic outlook to lowering borrowing costs. Again, a complete 180 from the governor. The governor and the president of the Bundesbank spoke to us on Eurozone policies over at Jackson Hole. Take a listen to what he had to say.
Germany has the capability to adapt to different situations. I think the world is changing. We are not happy with the current situation, so the trade conflict and everything is definitely not helpful. But at the end, we showed in the past our, let me say, strengths to come back and have a strong economy.
Post-Trump, can you and France and the other leaders of Europe reaffirm that growth, that spirit of growth that you had?
I guess we do something in the moment. We are going in the direction that you alluded to. We have structural reforms. We will do a lot of spending in new investments over the next year. So I think we do a lot of things in the moment, and I can guarantee you that there is a strong coalition on the European side. Germany, France, this axis is working again. And so I'm really confident that we can achieve a lot.
Given the fact that you could see some sort of mild recession in Germany, are you open to cutting interest rates further? After getting to 2%, which is sort of balanced, is it appropriate to become a little bit more accommodative?
Maybe a mild recession for this year, yes, this is true. But maybe we have also to think about that next year economic growth, there's a high probability that economic growth is coming back. When it comes to interest rate policy, I believe that we are in a kind of equilibrium. We have a 2%. We are on our target. This is good news. Interest rates are at 2%. So this is an equilibrium. So I do not see so many arguments that brings me to the point that we should do that we should do more here. So it's something. So I believe that inflation is not the point anymore.
Inflation is not the point anymore, that now it's potentially growth.
We are on our target.
But this is the issue. If inflation is not the issue, at what point do you see risk of disinflation, given the fact that the euro has been strengthening, right? That's importing disinflation. You have the potential for Chinese goods to be coming into the European region, cheap Chinese cars, that's sort of the cliche, that could lower prices. At what point are you going to be fighting disinflation again?
Well, it's definitely not time for complacency. So taking, for example, service inflation is still very high. It's above 3%. So we have to have this wait-and-see attitude. So this meeting-to-meeting approach is, I guess, the best way to do monetary policy in the euro system. When it comes to our September meeting, we will get new data, new projections, and then we will see. But at the moment, if I take all the numbers that I know, PMI numbers, I think not giving me enough arguments to change change the bars.
How high is the bar to cut
I think the bar is high. And so it needs a lot to convince me to change monetary policy.
ECB Governor and Bundesbank President Joachim Nagel speaking to Bloomberg's Tom Keene and Lisa Abramovich. So Jerome Powell, of course, sending the US bond market up on Friday by telegraphing the Federal Reserve could resume reducing interest rates as soon as next month.
The stability of the unemployment rate and other labor market measures allows us to proceed carefully as we consider changes to our policy stance. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance.
Let's bring in Ven Ram, cross-asset strategist for our Markets Live team. Ven, do the markets have clarity in terms of where this Fed goes beyond September?
Morning, Tom. I do think that Powell was pretty unequivocal. So, yes, the answer to your question is yes. The markets certainly have a sense of where the Fed is going. And I think that, what Powell messaged on Friday was that, look, the Fed is prepared to cut rates because they think that it is pretty restrictive, and given the July inflation print for unemployment, I think that the Fed wants to pivot again, just as it did at Jackson Hole last year. So I think that what that means is 2 rate cuts for the remainder of the year. But what the markets are not clear about is what happens in 2026 when we get a new Fed chief and possibly one who's going to be a lot more dovish. And we heard from James Bullard that they could get 100 basis points. So the markets are thinking that, look, we get 2 rate cuts this year and 80 basis points of rate cuts next year. And I think that the markets are clearly underpricing the risk that the Fed could take rates a lot lower than where it is indicated by the neutral rate by the end of next year.
Well, then, what does the pricing around disinflation in 2026 actually look like then? If the market is this split on the risks going into next year, what are they pricing?
Well, I think that there is a bit of mispricing in the steepness of the curve, Kriti, because I think that, as I was mentioning, that there is a lot of risk that the Fed will go a lot faster next year in terms of rate cuts, and that will keep send the front end rallying. We've got the 2-stance curve basically at 50 basis points now, and I think that curve has room to steepen, because on the one hand there's got this inflation, you've got this inflation that is kind of sticky around 250. We are well past the world where it's going to go back to 2% anytime soon. So I think in a world where inflation is sticky and the Fed keeps cutting rates willy-nilly, I think what you get is a steeper yield curve, and that's what the markets are missing at the moment.
What does that steeper yield curve mean for the US dollar, then? Are we back in an environment where we're selling the dollar?
Well, I think that the pronounced selling of the dollar is kind of over. And I was looking at my model this morning, and based on real interest rate differentials between the major economies. And what it shows is the dollar is kind of converging back to where it ought to be trading. It is still trading at a discount to fair value, but the deviation from fair value is not as sharp as it used to be. And I think that the markets are thinking that, look, the US dollar can still weaken, but the margin of deviation from the fair value has narrowed, and that shows that the markets are just hedging the risk of a weaker US dollar. They are not thinking that the US dollar is going out of fashion, and that's the key takeaway for the markets.
All right, Ven Ram, cross-asset strategist for Bloomberg's Markets Live team. We thank you so much for giving us his analysis, of course, this morning on the back of what we learned in Jackson Hole. We thank you so much. I'll shift the focus here to what's going on in Europe, and more specifically in Brussels. European Commission President Ursula von der Leyen has defended the bloc's trade deal with the United States, arguing that it brings stability and avoids escalating tensions with a key ally. Joining us now is Bloomberg's Brussels bureau chief Suzanne Lynch. Suzanne, von der Leyen is still being forced to defend this agreement. I thought we were all in the clear that stability was a good thing. Just walk us through the criticism she's getting.
Yes, I mean, the very fact that she was moved to publish this in a German newspaper over the weekend is significant. Germany, one of the biggest exporters to the United States and Europe, and a lot of unease there in that country about the terms of that deal and particularly what it means for the car industry. So, yes, I mean, the European Union had struck this verbal agreement with Donald Trump in Scotland back on July 27th. And then last week we saw finally a 5-page document, a joint agreement setting out on paper the terms of that agreement. Now, there are still some unfinished business, if you like, in that agreement, most notably on cars. So that higher rate, that 27.5% that's been charged, that tariff on European cars going into the United States, that is still in place until the European Union introduces its own legislation to cut tariffs coming in from the United States. That hasn't happened yet. EU officials are saying they're confident that by the end of the month they will, and then that will be backdated until the 1st of August. But in the meantime, those European car exporters are still paying that higher, much higher tariff that's costing hundreds of millions of euros each week, each day here in Europe. But as we heard there from European Commission President von der Leyen, she believes this was the best deal that could be done, and that was her setting out her stall over the weekend.
And Suzanne, given the criticism then that you've outlined from some national politicians across the Eurozone to this deal, how likely it is, or is it that it's got to get passed, it's got to be rubber stamped, or at least it's got to go through the voting process within Parliament, within EU parliaments? Is there a risk that the actual deal gets derailed?
Yeah, I mean, you're right. It's very complicated when it comes to the European Union because it's not one country. It's a collection of 27 countries. Now, trade is the competence of the European Commission. It is negotiating, if you like, on behalf of all the countries. But yes, there are some hurdles. But in saying that, I think people are very confident that this will get through the systems, that it's just a matter of, dotting the I's and crossing the T's. And the European Union did get some concession in that the Trump administration agreed that they would drop the tariffs after the Commission presents the legislation, not until every other step is finished. So that will happen quite quickly. So they're quite happy about that. In saying that, I think there is a concern in Brussels and all over the world about the terms of these agreements that the United States is signing up for. So, for example, some of the language there we see, like, the European Union should be covered by the 15% rate, for example, when it comes to pharma and semiconductors. I mean, the Europeans are very happy with that, of course. They're pointing out that Donald Trump has threatened all kinds of things on pharma imports into the United States. But under this agreement, at least, it's saying that the European Union will be protected from that, and this will fall under the 15% ceiling. But yes, I think there's going to be still a bit of uncertainty until this actually gets through that system and that these new tariff regimes are in place. And of course, there are other unknowns there. For example, on steel and aluminium, still not a deal on that. The Europeans will probably be part of a broader strategy on steel and aluminium, looking at the issue of overcapacity along with the United States. So those conversations are still ongoing, as is wine and spirits. The wine sector was not included in this deal. France and Italy are not happy about that. The European Union said last week it will continue to lobby for something on that. So let's see if they do get that over the coming weeks and months.
Suzanne, speaking of some of the pushback and criticism that Ursula von der Leyen is facing, Mario Draghi, a very prominent voice, of course, here in Europe and around the world, making his kind of feelings quite clear about not only the trade deal, but the European defense ramp up that's largely getting leaked to the United States, which is, again, something he warned about in the Draghi report. Just how much weight do those comments have?
I mean, the comments of Mario Draghi are important. Former Italian Prime Minister, former governor of the European Central Bank. And he has long been warning about the fundamental structural issues facing the European economy. This issue about competitiveness and this issue of lack of firepower, if you like, when it comes to the EU's industrial policy and innovation. Now, crucial to this is the long-awaited capital markets union, this idea that the European Union needs to integrate more in terms terms of capital markets, in terms of banking union as well. But to be quite honest, I mean, that has not been a focus for the European Union over the last 6 months. This has been a European Union in something of a crisis mode as it responds to some of the policy developments coming from Donald Trump, notably on trade and secondly, of course, on defence. Now, the European Commission here would say, look, it's doing a lot more on defence. It announced this 150 billion loan programme known as SAFE, and a number of countries, around 20 or so countries have applied to participate in that. So it says it's already making efforts on those fronts. But ultimately, a lot of those decisions on defence, etc., will come down to individual member states, individual countries' budgets. And as we know, a lot of those budgets are under pressure. So the big question is how they're going to finance this. How are they going to continue financing this need for more spending on defence?
Stuck between a rock and a hard place. Bloomberg's Suzanne Lynch, we thank you so much walking us through the dynamics in Brussels. We appreciate your time this morning. In the meantime, let's get a quick check on two of the major stocks that we are watching. I'll start with the Debbie Downer stock, and that is Orsted, down about 16% in intraday trading. This comes after a policy decision out of the United States. Donald Trump halting a wind project in Rhode Island for Orsted that neared completion to the tune of about 80%. And this, of course, comes after Orsted has already been facing quite a bit of pressure. The sell-off continues, down by 16% this morning.
Can I give you an interesting fact about JD Peet's before we check the share price? When you see the share price, look, it's soaring 17.5%. JD Peet's historically goes all the way back to 1753. 1753. It's a global coffee chain, operates in about 100 different countries. This is a takeover deal then. It is Dr. Pepper coming in with an offer, 18 billion. It's been confirmed, 18 billion US dollars, about 15.7 billion euros then, is going to be 31.85 euros per share. And JD Peet's, of course, soaring on the back of that news, up 17.4%. It's all part of a big revamp around the coffee business and the drinks business of Keurig Dr. Pepper, which has been struggling. So buying JD Peet's for the equivalent of 18 billion US dollars.
Talk about a sugar rush or a caffeine rush, if you will. Coming up on the program, we're going to talk about the other stock that may be getting a lot of momentum this week. And that, of course, is Nvidia. Those earnings coming up on Wednesday. We're going to dive into what's next, what to watch, and what the ripple effects of this world's largest company actually is. Stick with us. This is Bloomberg.
Welcome back. US President Donald Trump has sealed a deal that has given the US government a nearly 10% stake in Intel. The move comes as the US administration seeks to reinvigorate the company and boost domestic chip manufacturing. Let's get the details and bring in Bloomberg's Rob Lee. Rob, tell us about the shape of this deal. What do we know in terms of the government's stake in Intel now being confirmed?
Okay, in monetary terms, the amount of money being injected, or what it has been injected by the US government, or I should say in terms of external share purchases, approximately matches what was promised by the Biden administration under the CHIPS Act. So first of all, I think that's quite an interesting observation. So in theory, assuming this helps Intel on its journey to turn around over the medium term, at least the US taxpayer stands to get some sort of financial return, assuming this turnaround plan happens. But I suppose what it does prove from an Intel perspective and to the market as a whole is this is an endorsement, a strong signal of the backing, endorsement in Intel from the US government, and really signifying that this company is too big to fail, which is an expression for those with long enough memory, is something probably we haven't heard since the financial crisis of 2008. Yeah. But looking forward, obviously the CEO of the company has a humongous task ahead of him in terms of restructuring the company and also putting it back on the growth path. And just very quickly quoting some numbers for you, not even looking at this year's earnings forecast, but into next year's, consensus has downgraded or downwardly revised the earnings estimates for Intel by 83%. Since the beginning of January. So the earnings outlook for the business has deteriorated significantly year to date.
All right, Robert Lee, we'll leave the conversation there on Intel. We thank you so much, senior analyst over at Bloomberg Intelligence. I want to stick with the chip space, but maybe broaden it out to the geopolitics as well. South Korea's president is set to meet with the U.S. president in Washington later on today. Ahead of his trip, he met with Japan's prime minister as the leaders seek stronger cooperation with the United States. Let's get more from Bloomberg's East Asia government editor, John Herskovitz. John, just walk us through what we can expect from this visit.
Sure. So it's Lee Jae-myung, first visit to Washington to meet Trump, only been in office a few months. We're going to see things that include the trade tariffs that have been put on his country, quite similar to Japan. He talked about those tariffs when he visited Japan ahead of the trip to the U.S. And also we're going to see things like North Korea and China be part of this. North Korea always has a way of making a way into these sorts of meetings. The U.S. has talked about strategic flexibility. This term refers to allowing the U.S. troops who are stationed in South Korea be deployed in case there's a contingency in Taiwan. There are other things that are going on as well, from shipbuilding to automaking, but it's high stakes. Trump is asking a lot, and it's very difficult to manage what Trump may be thinking. So Lee Jae-myung's first trip to meet Trump, and he has a lot that he has to be concerned about.
John Herskovitz, Bloomberg's East Asia government editor, giving us a preview of this high-stakes meeting. We thank you so much for your time this morning. It's fascinating there, Tom. He was talking about the shipping industry, the defense industry, really creating a unified front in the Pacific as these trade negotiations with China are ongoing as well. One piece that he didn't quite mention was the chip sector. South Korea has this massive burgeoning chip sector. We know that Intel, we know that Nvidia are dealing with these geopolitics as well. I wonder how much of that gets some feedback, some commentary on not just from the meeting today, but Nvidia earnings on Wednesday.
And to what extent? You may be thinking, if you're an executive of Samsung and a recipient of some of the CHIPS Act funding, whether you're thinking about a Trump administration that's just taken a 10% stake in Intel and what that means for your prospects. The other takeaway, of course, is that Japan and South Korea are coming closer. China and India trying to repair their relationship, and that is a clear takeaway from a Trump administration that has, of course, upended some of the geopolitical narrative that we've been so used to.
Yeah, the economic line certainly being drawn. You have to kind of overlay it with all the geopolitics. The Russia exposure seems to be a key question coming between all the four countries that you just mentioned. When you look at these markets, it is a risk-off day, but light volume, light liquidity permeating throughout today's session. We'll see if it picks back up later in the week with Nvidia earnings and some of that data throughout the rest of the week. Jobless claims, European inflation, PCE. We've got it all for you. Stick with us. The Pulse is up next. This is Bloomberg.